Take 50 media. Everyone will tell you what to buy, but no one ever says when to exit. And you can't buy every single time either. You and I, we put in 100% capital, whatever that capital may be. When it comes to the upside, we are all in it together. But when it comes to the downside, then that's what makes all the difference, and that's the third thing. Only 5% can actually create generational wealth, so it's very important to be in that 5%, where your profits are unlimited, but losses are limited.
Welcome to the Market Pillars Uncovered. It is an educational series where we bring you powerful insights from the leaders who are shaping India's financial system. Today we have with us Mr. Rohan Mehta, CEO and co-founder of Turtle Wealth Management. With over 20 years of experience in equity markets, he is on a journey to make a global benchmark in quantitative investing. He is building Exit Mantra as a leading investor platform. He has a vision to create a $1 billion fund and is also known as one of the fittest fund managers in the country. Turtle Wealth is a disciplined, process-driven wealth management firm based on the Tertullian philosophy, fast and consistent investing, where there is a strong focus on timely exits and long-term winners. The firm follows a 100% quantitative, rule-based PPP framework, that is, the Price Profits People framework, with an exit before entry mindset, strict ethical filters, and transparent structures where risk management and long-term wealth creation are the top priorities. In this episode, we will talk about rule-based, data-driven investing, the exit-first mindset, and risk management through the PPP framework, portfolio construction, and much more. Rohan, thank you so much for joining us on Money TV to have a conversation with us today.
Thank you.
So first of all, we would like to know what are the core offerings of Turtle Wealth and what kind of services do you offer to investors?
We are a registered PMS fund manager. We also have a slash of PMS advisory for family offices, and thirdly, we are also distributors for mutual funds. We get mutual funds specifically for low ticket size of 50 lakh rupees. Second, we also have a tech portal on Quant. Because we started with a portal, what we want to focus on is the core side of investment, so that's where we are focusing. So, Exit Mantra is new baby where we are solving three problems. One is quant-based stock analysis with risk allocation. Second is to find super performers, sectors, and stocks. And the third is portfolio review in 10 seconds. So that is the fastest we have done in the world right now of reviewing equity portfolio in 10 seconds. And third, we have our own investing book where we have our own money like on. So these are three primarily business, but our core motto is to have decisions based on data, not by heart.
Exit Mantra sounds quite intriguing, so we'll ask you about it in detail. First, let's talk about exit first strategy, because this is one word, one term, that really fascinates investors. So what exactly is exit first? If you could explain that, or have you used it?
First, regarding contact, we need to understand that in the last 20 years, there hasn't been a single year where one sector has consistently outperformed the previous sector in terms of calendar year performance. So, what happens is, if we talk about 5 years ago, we didn't have many good companies to invest in. You would typically have 10, 15, or 20 companies where you could invest your money and it would do well. Now things are changing, new companies are coming, new forms are emerging, right? So, here we are pointing out that things are changing very rapidly. If you don't have an exit strategy, there are three problems that arise. First, if you don't know when to exit, you might end up taking a big loss, and if you take a big loss, that's not going to work very well for a particular company. Second, if that stock or business turns out to be non-performing, your ROTE will break. What is ROTE? It's return on time invested. We all talk about ROI, but above ROI, there's ROTE. That's why it's called ROTE, return on time invested. So, for example, metals were the best in 2019-2020. This calendar year, 2025, PSU banks are the best. Now, if I had invested in real estate or metals, maybe for that particular period, I would not have made money. And we have to make money, that is our primary objective of investing in markets. It's a very simple philosophy. And third is that the biggest mistake most people make is not holding their positions for the long-term trend if they is large. I'll give you an example. In the last 20 years, I have seen people losing more money by booking profits too early than exiting in loss. Let's say a company you bought at 100 rupees, you booked profit at 200 rupees, and that same stock went up to 2000, 5000 rupees. So, the alpha that could have been created in multiples is much more than the delta which is lost in the lost. So, exit is very important. People think exit is top loss. There are top loss, but important is that hold it for longer period of time, replace it if it not performing well or underperforming.
Your philosophy also includes a distinct element, the exit first mindset or the exit mantra that you were talking about. Knowing when to exit is often more important than knowing what to buy. So, how can this approach be used in volatile market phases? To protect their capital, even if there are any retail investors watching this show, what would you say to them?
So my clear point is that the website was created specifically for retail investors. You'll see that 50 media outlets will tell you what to buy, but nobody tells you when to exit. And you and I can't buy every time. We only have 100% of our capital, whatever that amount may be. So deciding when to exit is very important. Now, every stock has different exit points. For example, a large cap stock might have an average exit point of 10 to 15%, a mid cap stock could have 20 to 30%, and small cap or micro cap stocks could have even more varied exit points. So the exit mantra solves the problem by telling you, based on a 4 rating system, add, hold, replace, and exit, at what price you should exit onto it. And this has been done by nearly about 20 years of very deep research. What is the best time to exit a stock? And it's free, so retail investors can use it, and you don't need anyone else for it. So, let's give an example. For instance, suppose somebody tells you to buy something. Right now, there are 2 things. What will happen is either you will buy or not buy, or you will buy a small quantity. Now, if you go to exit mantra, you will know whether you should buy it or not and how much you should hold for a longer period of time.
Your investment approach is based on the PPP framework, that is, price, profit, and people. How exactly does this framework work, and how can it help investors make better investment decisions?
So, in the last 20 years of our research, along with 30 years of our back-end research and 50 years of global research, we have understood one thing. There are 2 types of investment process like what our moms follow: buy gold, forget it, make money, and stay happy. This is a great approach. Don't worry about the right power. Over a period of time, you will get good returns. And second, this is logical about investing. There you need data to take decision, not the heart to take decision. So we have seen that nearly about 600 indicators, out of which 3 indicators can find super performers / mega trends of the market, will lead 3 performers, and the first one is price. Once a stock does not make an all-time high for a long period of time, it is the best indication that stock indices or commodities are going to make a larger move. I'll give you an example. Gold. In 1980, it was $847, and then it came back to $847 in 2010. So for almost 30 lean years, nothing happened, but right now gold looks very good. However, nobody has seen or noticed that 30-year patch. In India, we made money because the rupee depreciated. In the US, of course, it was not the same. So this is the second thing I relate to price. I want profit to be there at the right time also. So let's see, Muthoot Finance has given more money than gold now. If I tell my mom, please don't buy equity, sorry, gold, you buy Muthoot Finance, my mom, as such, is going to throw me out. She says, you are mad, you shouldn't do it. But profit makes a more interesting point. So if a price is at an all-time high, if a profit is at an all-time high and there is a story which is happening in that company, there is a turnaround which is happening to the company, then all these 3 factors, you can find the best performer stocks, commodities, indices, or countries in the whole world. Believe me, we don't need a third thing. The rest is all just stories. So we see that no data, no storification, only datification. Is it the data talking or is it the heart talking? If it's the heart, then every day it will say something new. Data can't lie. There is a beautiful quote we say in the office, a sun can lie, but data cannot lie. So that's we have done.
You were talking about gold purchasing. Silver is another commodity where a very strong move has been seen. And you are also holding about 50 to 20% exposure to silver. So how did that happen? Why did you choose silver over gold? If you could share a bit about that approach.
So we had Muthoot Finance, it was the pair of gold, so it was very clear to us that if gold goes up, then finance related to gold will also go up. Even if gold doesn't go up, Muthoot Finance will still benefit because they get to subsidize off it, stand and do business, and gold is there for them. Second, we looked at silver on the same factor, and in the middle of 2000, in our PMS, weighing to 10% on an average, we bought our first investment for 80.64%. That is 80,000 silver. Believe me, nobody believe him. People were mad at me why I bought. Nobody buy silver. 20 is still there. I'll tell you a myth. In silver, in India, 73,000 silver was in 2011, and in 2024 it came back to 73,000. Just imagine, for 11 to 2024, so good 13 years, nothing happened in silver. Now people cry about silver. We are not bought, but nobody sees that lean phase, and we want the same philosophy. That one, when it was at one time high, it was a huge mismatch in demand and supply, that is profit. There was a stop where the commodity, and third, there was a huge turnaround story with green energy plus the EV cycle. What we are seeing in the world, we located this on a very high note. Today, we are holding at 4x of it for today only, and today is 2026. We started to witch trend in silver in our portfolio.
Okay, coming back to the data point, clearly, you believe a lot in data-driven and process-driven strategy, and you also execute it. So, for new investors who are watching this show, if you could explain to them in simple terms how quant investing works and why this approach is important for them, why it is necessary.
So I'll tell you two very simple examples. So in 1990, you go to a doctor and you tell them you have a problem. The doctor will check the nerves and then he will give you some medicines, and 67% of things will get better. So now, if you go to a doctor and you say something has happened, the first thing is to check out the report from your report. They will give you a report, point out what needs to be done, say this is your case, your sugar level is this, what does that mean? So, a help. From an economical or emotional point of view, it has gone to a stage where there is no datification, where you are raw, and for somebody else, it doesn't make any difference. For the doctor, it's the same person. Of course, high-low it changes for the person to person as per the risk metric. That's it. Second point, I'm a very big cricket fan. In 1990-2000, players would be chosen by the states not based on their performances, and they would remain for a longer period of time, even if the performance was not good. Right now, if a player is not performing for 3 matches, they are out because now data is taking the decision instead of a human being making the decision, and that's where the economic point comes in. So, if you see, in 1999, only 1% of the quant funds were there. Today, there is 39% of the funds which are contrary. India today would be 1%. In the next 10 years, biggest thing is quant. Now, quant is not only by the name quant, where the fund manager is taking decisions only based on the numbers, nothing else, and the importance of fund manager will become lesser, while performance will become high. So, it's a simple point. For any investor listening, you should ask 2 questions. Ask for the reasoning behind any decision given to you, not just a story or hearsay, but based on data. This is the point. Well, today, if a company is good, there is the highest probability that tomorrow the company will be even better. If today the company is bad, there is the highest probability that tomorrow the company will be worse. And we have seen hundreds of examples out there. What do? We take the example of one company that turned around. What we do is take that one hot company, turn around and leave it behind as an example. But we don't take examples of Unitech Kingfisher, Patel Engineering. These are all companies from 2008 and 80% of those companies got unlisted. So we should take examples, 100 of examples that went bankrupt, and one question is that why to invest. Second is, when it comes to exit, everyone talks about the upside, but in the downside, that's when you really know what is substantial.
If we talk about investing in equities, given the volatility and uncertainty in the market, especially with the way macros and geopolitics are playing out, then in such a market, what should be the filter or approach to identify super stocks or outliers?
So, again, these are my 3 key parameters. Let me also add an exit strategy. Let me talk about both sectors and stocks. The sector that is making an all-time high, so we have 3 things in India. One is the broader market, like your Nifty 50, Nifty 500, second, sectoral themes, and third, thematic themes. So, when we talk about sectoral themes, the sector that is making an all-time high, and if you look at the stocks, if the stocks are making all-time highs, then obviously the sector will also be at an all-time high. And second, it is outperforming the Nifty 500. If these 2 things are happening, then that sector must be outperforming. For example, the past 3 years, everyone was in private banks, but in the last year and a half, which has given the highest returns, public sector banks have. SBI, Indian Bank, and Federal are at all-time highs, whereas private banks are not. So, first, I will talk about these factors with data on how to pick stocks based on 3 things: stocks at all-time highs, profits are at an all-time high, and the stock is outperforming Nifty 500. These 3 sectors are being amalgamated. So why these 3? Your stock at all-time high is the factor of price, profit at all time is the factor of finance, that is, fundamentals, and the stock is outperforming Nifty 500. This is the amalgamation of momentum. So, it's a mix of all 3 things: profits, price, fundamentals, and third, momentum. If all 3 are present, right, there is the highest probability that the stock will outperform the markets in, let's say, a 1-year scale, 2-year scale. Again, it's not a guarantee, it's a probability.
Now, talking about sectors, in the current market, if you have to give a vision or outlook for the next 4 to 5 years or till 2030, are there any sectors that you feel have the most potential?
Whenever you look at any sector, everybody says that in the last 18 years, not a single sector has remained the top one. Every year, the leading sector changes. I only know about 2026, not 2030, and I am telling you this with complete honesty and sincerity. I don't know. But if we look at the data, then we will have the highest probability to find that sector. So today, your top sectors that are outperforming are Nifty Auto and Nifty Financial Services. These are the top sectors that are outperforming, maybe till 2026. And I don't know beyond that, but the data will speak for itself. So, I am not making any assumptions, and this is the kind of clarity a fund manager can give that I don't know. I think that's the real honesty. If a fund manager says he knows, he's just saying it from the heart, but where is the data to back it up? For that.
So, Rohan, when you look back at your career so far, what do you think were the big turning points? Is there any incident or lesson that you always remember?
There are so many. I could do a podcast for the last 2 hours just on them. About lessons, there's a very nice quote from a city that says, "Who has learned from whom?" Everyone needs an accident. So, only when accidents happen do stories get made. But I tell a one or 2 things which in my very big learning point is that one is never underestimate mega trends. Mega trends are the only way to make large money in markets. So, cut out the noise. Focus on things which are making money. Hold on to the stocks that are doing well and put more money into them. If a stock is doing badly, sell it. And keep replacing the ones that are just going east-west. So, this is a very big learning. And second is that your conviction idea should have higher allocation. It's not just about what you buy, it's also about how much you buy. Let me tell an example. Let's say, for example, I am very bullish on silver, but if I have only 1% in my portfolio, how on earth is it going to make an impact on the portfolio? Take this to 2025 calendar year. Look at the top 5 PMS in the multi-cap, flexi-cap sector, right category. Because equity has not performed well, so one idea can make a larger impact over the period of time. And last but not the least, there are three typical type of investor is the one who says, I have limited profit, I just want to make this much profit, but the loss could be anything. That's one type of investor. The second type says, let me make this much profit, but also limit my loss to this much. The third type of investor thinks, who thinks asymmetric profit should be unlimited, but loss should be limited. The first type will end up losing their home. The second type will manage to run their household, but won't be able to build a new one. The third type will be able to create generational wealth. In third, about 5% fall into this category, so it's very important to be among this 5% where profits are unlimited and losses are limited.
So Rohan, moving away from the market, when you're not investing or not tracking the markets, how do you unwind? Do you have any hobbies or interests you follow at your core?
Work like in housemaker. Let us not say housewife because it's housemaker means by 5:30, cut off. I go home, you have to do other duties. That's how I have my schedule, and I am Odysseus, reader. I read every week. One book, that's my rule. Second is extreme freak on health and sports. I love sports, play shot, play badminton, work out every day. And last is that I sleep well.
See, I think so the biggest flag in next 10 years is, it's going to be about who can keep their body very fit, and second is who can sleep well. Because if you can sleep well, you're not more concerned about a lot of things. So yeah, and of course, friends and family are important for everyone, but I have realized one thing, if you can sleep well, you're doing well in life. So that is equal to life a simple man, but a very, very hard worker with a hard taskmasters.
Rohan, thank you so much for such clear and cutting insights that you shared with us and our viewers. Thanks again for joining us on Market Pillars Uncovered.
It was a pleasure.
And with this, today's episode of Market Pillar Uncovered comes to an end. Don't forget to like, share, and subscribe to the Money TV so that you keep receiving updates. For more thoughtful conversations and expert insights with India's leading market voices, stay tuned till the next episode. Stay smart and stay informed.